Hello, my name's Craig Earle, market analyst at ALPARI UK, and welcome to our daily market update. Today we've got European indices all trading low. We've got US futures pointing to a similar open as well, but I think a particular note is the FTSE Mid, which is currently 1.8% lower off the back of that Italian bond auction this morning. Now, it went largely as we were expecting. We saw the borrowing costs actually creep higher compared to a similar auction last month, as we saw earlier on this week on Tuesday when we saw an auction of one-year debt as well. We saw these yields creep high by around 20 basis points, and we've seen something similar here today, so there wasn't really too much of a shock to this. I think the negativity surrounding this auction has actually come in the form of the demand. Now, the demand wasn't necessarily bad. It was pretty respectable, but it wasn't necessarily good either. We saw bid to cover ratios of between 1.2, 1.4. So not necessarily a bad bid to cover, but not necessarily a great one either. I think this was a smaller demand than we were expecting, and I think that people are reading that to think that maybe people are less comfortable holding Italian debt now due to all that political uncertainty which we're currently seeing, given the fact that these elections are still given the fact that we've still not got a government in Italy, and given the fact as well that we saw that Fitch downgrade earlier this week. So I think that's what's really driving Italian markets down this morning, and also therefore as well all the other European indices as well. Also today, the economic data we've had out hasn't necessarily been great. Again, it hasn't really been bad, but it hasn't really push the markets higher as we could have potentially hoped, distracting the markets away from that slightly negative Italian bond auction. We've had industrial production figures come out which showed a 0.4% drop month on month, which was lower than we were expecting. We were expecting a smaller drop around 0.1%, but then again, like I say, it wasn't necessarily as bad as it potentially could have been viewed. If you take a look at the year-on-year figure, that showed a drop of only 1.3%. Now, we were expecting a drop here of around 2.2%. So all in all, it's not necessarily good, but it's also not necessarily bad either. It's not really causing too much movement in the markets, especially as well given the fact that the previous figures were also revised higher. So if anything, it's actually slightly positive for the Eurozone rather than negative. But I think this morning what we're seeing is the Italian debt auction actually taking at the forefront of people's minds and currently driving market sentiment. Looking ahead to this afternoon, I think the main focus really in the US is going to be on those retail sales figures. In January we saw consumer sentiment actually fell. We saw the surveys fell back following the introduction of the payroll tax and also the taxes on the top 2%. And we saw that reflected in the retail sales as well in January, which came out at a small gain of 0.1%, which was actually higher than we were expecting back in January. Now we've got the February retail sales. We did see an improvement in that consumer sentiment figure, so we're expecting a slight improvement here to around 0.5%. But I think these are going to be what's really closely, as I think this is going to give us the best indication that we're going to get as to how consumers have been affected by this payroll tax, and also whether they viewed the sequester in February as a real threat or whether it was just built up in the media and built up by the politicians to be more than it actually was. So I think there's going to be a lot of attention to this retail sales figure here today. Finally, today we'll take a look at the euro-dollar charts. Now, as you can see on this daily chart here, we've seen some consolidation in the pair over the past couple of weeks to the point where we've got that bottom around 129.50 where it's really struggling to break below, but we've also got that descending trend line dating back to the start of February, which it's failing to break above. And what this has resulted in is a descending triangle. Now, this tends to generally be quite bearish. We tend to see, technically speaking, we tend to see a break below here, but if we do see a break above, then we could actually see a move up to around 133.50, 134 area. However, like I say, if we see a break below, which is what we tend to see in this situation, obviously not all the time, but this is what we tend to see here, then we're looking at support levels, probably around 129, which is a major support level. Then looking at that 50 Fibonacci retracement level around 128.75, and then just below here again, you've got that 200-day simple moving average. So depending on which way we break out here, I think we could see a few more days of consolidation here, but once we see a breakout, then these are your two targets. You've got 133.50, 134 on the upside based on the size of the entry into the triangle, and then 129, 128.75, and that 200-day simple moving average around 128.50 below. For more news and analysis, check out the ALPARI newsroom, which can be found at alpari.co.uk/newsroom, and you can also follow us on Twitter. Thank you very much for listening. My name's Craig Earle, market analyst at ALPARI UK.